Hi, Matt McAleer, Director of Equity Strategies, July 8th, just after the close. I'm with Patty Healy, Senior Vice President, Head of our Credit Research in our Fixed Income Department. Patty's going to share some thoughts on what we saw this week in fixed income. Equity-wise, what did we take out of the market this week? If we were looking at a positive, it was that we got that down hard open on Tuesday morning. Remember, it was a 3-day weekend. Tuesday morning, down 2% right out of the chute. By 10:30, S&P really struggling. And that was the low of the week. Some demand came in. Interesting, right? Because what we've seen thus far is good, strong week 2 weeks ago, gave some of it back last week, and then opened very weak on Tuesday. The pattern has been to continue with that weakness. But it got a little sticky. Some demand came in, some buyers came in. It could be that people have positioned themselves as negatively for the short term as they care to. Let's take a look at the first chart here. This is the American Association of Individual Investors Sentiment Survey. By the way, sentiment is a secondary indicator. We don't trade on sentiment, but it is a puzzle piece. Take some time to just read through there. Bullish sentiment is below 20% for the fourth time in 7 weeks. Historically, 1 or 2 times below 20 is a buy signal. Just showing you how negative the market is right now, Patty, on the equity side. Bearish sentiment above 50% for the third time in 4 weeks. I can remember if it got through 50% once, you were a buyer. Again, showing how negative sentiment has become. What we like to do is try to match sentiment with some actual positioning. Let's take a look at this next chart. Commitment of Traders Report. This is a report that gives you an idea in the futures market how traders are positioned. There are commercial and speculators in terms of traders. Commercial traders are trading for an industry or a company, or it could be a pension fund. The point being, commercial traders tend to trade with less emotion than speculators, whether they're large hedge fund or small speculators, which are individuals. When we see extremes between the two, we have to take notice. Note down at the bottom where the commercials are net long the S&P futures, while speculators have their lightest positioning in some time. So again, we need to at least be aware of where capital is positioned and see if we can take advantage of that. So continued strength out of healthcare this week, and continued strength, we mentioned this the last couple weeks, Patty, out of the most beaten down sectors. Alternative energy, biotech, sectors that had really had a tough 12 months. They've continued to be strong. Some people will call that a dead cat bounce. Others will say the worst have to repair themselves before the rest of the market can move forward. We don't know the answer to that. It's just things we are noticing. Again, the equity markets, like the bond markets, are a puzzle. There is no one perfect key to when you come in or when you come out. So, Patty, we had some reports this week. We even had a report today, a jobs report. Bonds have been volatile, but kind of staying in a range. What did you notice this week?
Yeah, for sure. I mean, it was, the 10-year was at like 280 last week. Now it's at about 3% on the 10-year and about 323 on the 30-year. And been listening to a few pundits talk about their long-term range, and same with us. We're thinking it's pretty much going to be at about 3% at the end of the year for the 10-year. The jobs report today was good, and a lot of sectors were up. So I think people are expecting that the Fed, because jobs are still in demand, in some wages went up a little bit, that the Fed still is going to increase rates by 75 basis points next month. We'll see if that happens or not, but some of the signs are for that. In the Muni sector, space, particularly
June and July, right? Big
Well,
Muni maturity months.
Sure, we got a lot of maturities, and we've got maturities, coupon payments are very big in June and July. That means all that money needs to be reinvested, and so luckily in this case we have about 10 billion in supply. Those are new issues coming to the market next week, about 10 billion, and that's higher than it has been. Also, the number that we look at all the time is mutual fund flows. There have been negative fund flows for a number of weeks now, 2 billion at a clip. And this week it was only like 330 million. So we're seeing outflows less. And talking about people that are buying in the market and not buying in the market, we've seen, some retail has moved out of, like the mutual funds, but we've seen banks move in. We've seen what we call crossover buyers, people that generally buy taxable bonds, buying muni bonds because the yields on munis have been so high that it's higher than the taxable equivalent yield that you could get on something else.
Still seeing 4% plus on the longer side on the munis.
Yes,
and credit has remained solid now.
Credit is definitely solid. Munis have had a whirlwind of money come at them from, more income tax being paid, and the stimulus funds and what have you. Now, the downdraft in the markets has affected their pension funding levels, which can be a big concern for munis. So we're going to see how they manage that. Also, the problem that some governments have is that they see all this extra money around. They're saying, oh, well, we can fund this program, and we can fund that program. And then when those monies dry up, it's almost to the point where S&P said in one of their articles, it appears that some of these governments are having a hard time figuring out how to spend some of the stimulus money that's there.
Yeah.
And it has to be spent on specific things. So it's going to be a wait and see. Things like airports are doing very well because of the return to travel.
Sure.
Which is kind of interesting because that used to be more of a volatile sector.
That was a speculative. Airport bonds.
Well,
used to be-
airports.
Yeah.
Airlines are speculative, but yeah. So at any rate, I think we're very constructive on munis. The muni treasury ratio for the 30 years is still at 92%, higher than kind of the average, and 10-year muni treasury ratio is at about 80%. So
Great.
yeah, munis are looking good.
Good. Thank you, Patty. Don't forget to like, comment, and subscribe so you can follow along with our videos weekly or in any intra-week videos that we do, especially in volatile times. Enjoy the weekend, and we'll see you next week.